Hello, I'm Ryan Light for Amanoff, and welcome to the second in our webinar series rated by Kepler. Today, we are joined by Ayush Abhijit of the Ashoka India Equity Trust. Despite being one of the newer trusts in the sector, having launched in 2018, Ashoka India has an excellent performance track record, having outperformed over numerous timeframes and delivering impressive returns of over 180% in NAV terms since inception. Over the next 30 to 40 minutes, Ayush will talk us through the strategy, the current positioning, as well as the investment case for Indian equities. We will then open up the forum to your questions, which can be submitted via the Q&A box in WebEx. So without any further ado, I'd like to hand over to Ayush.
Thank you, Ryan, and good morning, everyone. Thank you so much for taking out the time to join us today. I'll split my presentation in two parts. In the first part, I'm going to talk a bit about the strategy, covering performance, attribution, the portfolio positioning. And then in the second section, I would touch a little bit upon the macro setup in India, some of the key questions that many of you have asked us over the last couple of months, and then we open the floor for Q&A. For those of you who are new to Ashoka, Ashoka India Trust, launched in 2018, is run by White Oak Capital, fund set up by the former CIO of Goldman Sachs Asset Management. We manage at a group level just about $10 billion and have two primary strategies. The first one being the India equity strategy, and the second is a global emerging markets strategy. So those are the two key strategies that we run, and Ashoka India Trust is part of our flagship India equity strategy. Let me dive into the performance straight away. We launched the trust in 2018. This is our 7th year of running the trust. And when we launched Ashoka Trust, we started with three key propositions. Number one, we said we are not going to charge any management fee. Number two, we said we'll only have performance fee. That too on outperformance or alpha generation, and that to measured over a 3-year period. Okay. And we have a discount control mechanism of annual redemption at NAV once a year. And this is how the scorecard looks like for us. Since the launch of the trust, it has compounded at 18.5% annualized in dollar terms, compared to 11 for the market, resulting in an annualized alpha of 700 plus basis points. I must emphasize here that the returns, 18.5%, are net of everything. These returns are net of fees, net of performance fees. These are also net of realized taxes, as well as net of provisions for unrealized capital gains taxes. Okay. So it's more of a apples to oranges comparison. Our gross alpha would be much higher than what you see here. A quick review of the last calendar year, 2024. As you can see here, the second row, 2024, we closed the year on a strong note. The trust delivered 23.8% returns with an alpha of 866 basis points. Again, net of fees, net of everything. This comes on the back of a very strong 2023, where the trust had 24.5% returns with an alpha of 600 plus basis points. So two back-to-back very strong years with the very attractive alpha net of fees. Compared to peer group, this is how the scorecard looks like. Since inception of the trust, it has compounded at 18.5%, whereas the other three India trusts have compounded at 7.2 to 10%, 10.9%. So a meaningful gap between the Ashoka Trust and the peer group. As a result, the trust has, for majority of the last 6+ years, has traded at a modest premium, about 0.5% premium on average, whereas others trade at a discount. And this has allowed us to have an active share issuance program. The trust has grown as a result. I'm very happy to share with you that the trust has grown more than 10 times now since we have launched. When we launched, it was just shy of 50 million. Today, we are just about 500 million. So tenfold growth in the size of the trust. And I would like to take this moment to thank those of you who have entrusted your capital to us for your trust. A very important part of our investment style has been a very bottom-up stock selection philosophy that is rooted in finding companies with strong competitive advantages, high returns on capital, companies that have scalability, companies that are run by exceptional entrepreneurs, that are run by credible management teams, and they're run while adhering to good corporate governance. We buy these companies and we own these companies as long as they present a substantial discount to intrinsic value. We have a team of 32 investment professionals. Majority of them are based on the ground in Mumbai. So it is by far the most well-resourced team compared to any other India manager. And some of the brightest, sharpest analysts that you could find in India today. And this team of 30 plus analysts conducts a very extensive due diligence program, conducting more than 3,000 meetings every year, meeting company managements, competitor, talking to customers, talking to suppliers, talking to distributors, talking to regulators, industry experts, ex-employees, running consumer surveys, in a way, running a holistic 360-degree due diligence program. And therein lies the primary source of strong alpha generation capacity in the trust. From a portfolio construction philosophy standpoint, there are three things that we do. Number one, no market timing. We do not try to time the markets, always 100% invested. Number two, no sector rotation. Sector rotation is a very popular preoccupation of many investment managers. We don't think it's a reliable way of generating alpha, and never take any top-down sector bets. So always remain truly bottom-up. And number three, no macro bets in the portfolio. We do not have strong view on the macro. We do not have a strong view on the markets, and do not take any explicit or implicit macro bets in the portfolio. As a result of all of this, if you look at our attribution analysis since inception, and this is attribution by size, you would see that you can break down attribution into two parts: stock selection and allocation. Stock selection is the alpha that you generate by picking the right companies, by picking the right stocks. And allocation is the alpha that you generate by being present in the right areas, here being present in the right market cap segment. So if you break down our alpha over the years, you would notice bottom right, out of 187%, 166 comes from pure stock selection, the skill element. And allocation is more of a zero-sum game over long periods of time. So you would notice that just about 90% of the alpha comes from pure stock selection. You can run attribution by sector. Again, very similar results. Out of 187%, 176 comes from stock selection. So 95% of the alpha on a sectoral perspective comes from pure stock selection. About 5% is contributed by being present in the right sectors. And to our minds, this is one of the most powerful analysis of the quality of performance. Stock selection is perhaps the only reliable way of having any sort of confidence in the repeatability of an investment manager's performance. Had all of our performance come from allocation instead of stock selection, we should have been very worried. But because it comes from stock selection, this is the repeatable element in investment decision making. Year to date, again, similar stats, 17.5% alpha, gross alpha, 14.7 comes from stock selection, allocation is about 15%. 85% comes from pure stock selection. Same story from a sectoral perspective. Last calendar year, we had very good stock selection alpha coming from consumer staples, healthcare, industrials, technologies. Those were the areas where our stocks have done really well. And finally, wrapping up on the top contributors and detractors in the portfolio. Calendar year 24, Zomato was the top contributor. It is the leading food delivery platform and also the #1 quick commerce platform that is in a way disrupting traditional retail, modern retail, gaining market share and growing rapidly in India. The stock was up 122%. ICICI Bank, a long held position in the portfolio. It's one of the finest private sector banks in India, as well as in Asia. Up 28%. It is a large cap, mega cap stock, in fact. Azad Engineering, a precision component manufacturer for the aerospace industry. Inventor's Knowledge Solution, a specialist technology services company catering to clinics and sort of clinical chains in the US with a very strong bouquet of offering, a lot of it around machine learning, artificial intelligence geared towards improving the productivity of physicians and clinics. And Newland Laboratories, which is a pharmaceutical company that specializes in contract development and manufacturing. So you can see winners have come from very different industry segments, very different business models, and have contributed handsomely to outperformance. On the right-hand side, you can see the key detractors. #1, Nestle India. Nestle also has been a long-held position. We think it is one of the best consumer staples companies in India. And consumption has been a bit weak, particularly at the bottom of the pyramid. Has been a pain point for the economy, for many of the companies in the consumer segment. And Nestle has been a detractor. Apart from that, we've got IIFL Finance, a position that we've exited. Bajaj Finserv, again, a modest 7.9% negative return last year, but the markets did very well, so this is a detractor. And Titan, a jewelry retailing company, Sonata Software, a tech services company that specializes in Microsoft product suite. So that's how a quick flavor of how the top contributors and detractors look like for 2024. Now I want to show you a very interesting analysis. All of the returns that you see have been generated while owning a large number of positions in the portfolio. And it is counterintuitive to many of our investors who often think that concentrated, high conviction, few and lesser number of stocks is the only way to invest and right way to invest. What we have in Ashoka Trust is a diametrically opposite style, which is a very fragmented collection of idiosyncratic risk factors in the portfolio. No big bets, no outsized bets on any single company, any single industry, any single sector. Since inception of the trust, we have taken 269 investment decisions, of which 166 have been positive alpha decisions, which leads to a 61% strike rate. So all the investment decisions that we've taken since the launch of the trust, we have gotten 61% of them right, 39% of them wrong. For context, 55-60% is a very high strike rate, a very good strike rate in our profession. So this would be amongst the top percentile strike rate anywhere in the world in long only equity investing over any reasonably long time frame. And you can see the tiny bars on the right hand side. You can see once we get a stock right, what is the alpha contribution? And you would see there are multiple stocks that have delivered 600, 800, 1,000, 1,200 basis points of alpha. On the left-hand side, you can see the bars are much smaller. That shows you how much alpha do we lose when we make an incorrect investment decisions. And here you can see the damage is fairly controlled. In our worst investment decisions, we have lost 200 to 400 basis points of alpha. So there's an inherent asymmetry of probably 1:3 or 1:2.5 in terms of how much money we make when we get it right versus how much we lose when we get it wrong. So this is risk management at work. We have not allowed any investment mistake burn a big hole in our portfolio performance, and that's what we'd like to see in your portfolio. Moving on, coming to our portfolio positioning. The top right, top half, you can see the various sectoral exposures. As always, 5 key areas form sort of the core pillars of our portfolio: financial services, consumer, both staples and discretionary, technology, healthcare, and industrials. So these are the 5 key areas where bulk of the portfolio resides. Apart from that, we have smaller allocations to real estate, communication services. In the middle, you can see energy and utilities. That's one area where we tend to run structural underweights, not because we are negative on these sectors, just that given our investment philosophy and process, we do not find opportunities that are attractive enough, that meet our thresholds. Bottom left, you can see the market cap exposure. Just about 28% of the portfolio is in large caps, 14% in mid caps, and small caps about 56%. The numbers that you see within these bars represent the number of investments or the number of positions that we have. And you can see it's very well distributed portfolio. Overall, we've got 149 positions in the trust as of today. So very well diversified, very well spread out. On the bottom right, some key sort of portfolio characteristics. On accounting earnings multiple compared to the index, just marginally higher than the index. But then in terms of return on capital, about 300 basis points higher return on capital. In terms of growth, projected earnings growth is again 3 percentage points plus higher. So our portfolio companies have far superior economic characteristics, quality characteristics, growth characteristics, competitive advantage, quality of management teams. All of that is far superior than the average company in the index. And therefore, this modest premium that we have to pay to buy these companies is very well justified in our view. With this, I've come to the end of the first section, which is a quick review of our portfolio performance, attribution, and the current positioning. With this, now let me move to the next section, which is talking a bit about India. Now, the long-term case for Indian equities has remained pretty much the same for the better part of the last 10, 20, 30 years, which is and very well understood, very well recognized. 4 key pillars. The country is going through a once-in-an-era economic transformation. It is going to be the 3rd largest economy in a few years from now. Today, it's probably the 4th largest or 5th largest economy. Will be the 3rd largest after US and China. Number 3 is going to be India. The growth is very domestically driven. Consumption is about 60% plus of GDP. Very attractive demographics. And importantly, a very heterogeneous investable universe. Unlike other emerging markets like Korea or Taiwan or even Brazil, those markets are very concentrated in 1 or 2 sectors. For example, if you go to Korea or Taiwan, electronics, semiconductors would be 50 to 60% of the investable universe. India is a very heterogeneous market, right? So fertile grounds for active stock picking. And the 4th pillar, and we've always believed that this is the one that is less understood, misunderstood many a times, that India possesses the soft infrastructure of a mature democracy, which in turn means having separation of powers between the judiciary, the legislative, the executive, peaceful transition of power, mature democratic processes, mature democratic institutions like having an independent central bank, having an independent election commission, and very importantly, having strong property rights protection, right? Rule of law. While many of these things that I described are a given in many developed markets, these are not a given in emerging markets. And therefore, a very important aspect to sort of think about, and we can go deeper into this if you have further questions. When you think about India's valuations and why India trades the way it does, a lot of it is a function of point number 3 and 4, the heterogeneity of the investment universe, superior return on capital, and this mature soft infrastructure. Now, taking a closer look at sort of some of these things. So the long-term history of stock markets in India, and on the screen you can see the 30-year history, the last 3 decades, which is pretty much the entire post-liberalization history of the Indian stock markets. The country liberalized in 1992, and over the last 30 years, the index has returned 11.9% plus 1.5% in dividend yield, so about 12.5% annualized is the return of the index. That's the beta of the market over the last 30 years, which also happens to be in line with the nominal GDP growth rate of 12.5%, which is also identical to the earnings growth, the corporate earnings growth over the last 30 years. So in case of India, nominal GDP growth rate or economic growth has translated to corporate earnings growth, which has translated to stock market returns. So there's a very strong correlation between these three. Economic growth continues to be fairly strong in India. It has averaged, between 6-7%, continues to be in that level. So the GDP growth rate has been very attractive. India is the fastest growing large economy in the world today. In terms of global growth, punches way above its weight. But then earnings, corporate earnings tend to be cyclical in nature, right? So there are multiple phases of corporate earnings growth. And as we stand today, over the last 5 years, we are in that phase of very strong corporate earnings growth, largely got to do with the graph at the bottom left, which is corporate profitability is expanding. There was sort of a 10-year cycle of decline in corporate profitability, bottomed out in 2020, and then over the last 4 or 5 years, we've seen corporate profitability go up, and therefore earnings growth has been in high teens, above the long-term trend line of 12.5% earnings growth. Now, I want to take a closer look at sort of what's been happening in the markets lately, because a lot of questions that have come from a lot of our investors have been around that. So while the last 30 years, 12.5% annualized, that's the kind of return that the index has delivered. And last sort of 4 to 5 years have had very strong equity market returns. In the last 3 to 4 months, we have seen a bit of a pullback in the markets, right? And this graph, the first column here, encapsulates that pullback that we've seen in the equity markets. Par for the course. The benchmark Nifty 500, which is the all cap, the broadest measure of equity markets, is down about 11.5% from its all-time high. And the multiple, you can see at the bottom how various segments of the market have reacted. So on one hand, segments like utilities, energy, defense, oil and gas, public sector utilities, these are some pockets of the market that have seen a sharper pullback, 20 to 25%. Whereas at the bottom, you would notice that pockets like technology, financial services, healthcare, private sector banks, these are the pockets that have done much better compared to the broader index. And some of it has also got to do with of the fact that segments like defense, energy, utilities had been doing really well in the prior 3 to 4 years, right? And therefore the pullback also is sharper in that segment of the market. So as we stand today, from the peak of the market in September of 2024, 4 months in, we have seen 11.5% kind of a drawdown point to point. Now, there are multiple narratives in the market. Some of you have asked us that, what is the reason behind this kind of a drawdown? And it is very hard. It is impossible to in the absence of any cataclysmic event like the pandemic in 2020, in the absence of such events, it is very hard to attribute one single factor to such corrections. But there are multiple narratives, and I'll talk about what are the key narratives being discussed in the context of this correction. One is that the sort of earnings growth that I spoke about earlier, earnings growth has been a bit tepid in the current fiscal year. So if you look at this graph, top left, that captures index earnings growth over the last sort of 25 years. And you would notice that over the last 4 years, earnings growth was pretty strong. 2021, 14%, 2022, 33%, 23, we had 13%. Last year, FY24, it was 20%. And this year, FY25, at the beginning of the year, the expectation was that the earnings growth would be about 12%, and then we've seen downgrades through the year, ending at about 5%. So there's been some moderation in, and that's the nature of corporate earnings. They tend to be a bit volatile. So there's some bit of moderation that we see in corporate earnings growth. Next year, which is fiscal 26, again, consensus expectation is that earnings go back to mid-teens. We'll see how that plays out. And if you double click on sort of the earnings growth profile and really find the composition of this 5%. So this is how, for the Nifty 50, how the earnings growth looks like. So you would notice that financial services, which had grown at 17% last year, have seen a fair bit of softness. They have 6% earnings growth. Technology is coming back, 9% versus 3%. Energy is sort of negative 13% earnings growth. So these are some of the reasons why earnings growth is coming out to be lower than the last 3-4 years. And next year, you can see fiscal 26. That's how the consensus expectation is 15% earnings growth. The second reason, or the second narrative, is around flows. And typically, in the case of India, we look at two cuts of flows. One is foreign flows into India, and the second is domestic institutional flows, right? And we'll spend some time going through both of these. First, top left graph captures the foreign flows coming into India. And here you would see that this calendar year, 2025, which means in the last 30 odd days, foreign investors have taken out $8.4 billion of capital, right? Which is a fairly sharp kind of withdrawal in that short period of time. Last year was more of a flat year, 0.8 billion negative. But through the year, in the first sort of 9 months, 6 to 9 months, there were inflows. And then second half of the year, we did see those entire inflows getting reversed. On the top right, and then there are multiple reasons being attributed to these outflows. In September, October last year, you would recollect that China announced a mega stimulus, $1 trillion, 7% of GDP. And there was some bit of sort of capital that flowed out of India into China. Then in the later part of 2024, once Trump won the elections, there was, again, some flows moving from India to the US markets. So multiple narratives around the reason for sort of these outflows. On the right-hand side, you can see domestic flows into equity markets. And they have been very resilient. In fact, last year, 2024, domestic asset managers bought $50 billion worth of equities. This year to date, $5.3 billion. So you can see the domestic capital is sort of counterbalancing the foreign outflows that we've been seeing. And systematic flows into equity markets, bottom right, these are monthly flows, which tend to be very resilient to market volatility. And 2020 COVID year is the case in point here. They have been tracking well at just about $3 billion per month. So $36 billion of contracted flows coming into the equity markets in India. Now, just going a bit deeper into sort of the foreign outflows that we've seen. It started in September 24, and these are various instances of, this is nothing new. We have seen multiple such instances over the years. Here you would see the current outflow that we've seen from foreign investors totals about $20 billion, started in September 24. But if you put that in context of the size of the market, which is the second gray column, the current outflow amounts to about 0.4% of the market cap. So it's much less than the last two kind of outflows that we saw. One was during in November 21, July 22, so in or around Russia, Ukraine. Prior to that, we see that outflows were during the COVID pandemic. So there are multiple such instances of these outflows. The Indian capital markets have been very buoyant throughout 2024. In fact, the best year for primary capital raise, IPOs, qualified placements at an all-time high. In the trust, as you would know, that we can allocate up to 10% of the trust in pre-IPO opportunities. And very happy to share with you that the pre-IPO strategy of taking very selective investments in certain pre-IPO companies has delivered a very strong outcome over the last couple of years. Another question that we have received has been around the impact of, and this is something that every country in the world is trying to grapple with, which is, what does Trump mean for the economy? In the context of India, apart from all the rhetoric that is going around tariffs, around trade wars, from India's perspective, two sectors that have reasonable exports, IT services and pharmaceuticals, we think that IT services at the margin would be a beneficiary of the Trump regime, primarily because there is a greater likelihood of corporate tax cuts, which means more money with businesses in the US to spend on their IT architecture to upgrade their technology landscape, and also deregulation, right? Lesser government, low regulation has also been a rhetoric, and we're likely to see probably a lax Basel III implementation for US banks, which means higher profits. They are the biggest customer of IT services, and therefore net at the margin we see Trump being positive for IT services companies. For pharmaceutical companies, could be sort of slight headwind, a modest negative, but that primarily is for the generic companies. And within the trust, over the last several years, we have not had meaningful exposure to generic pharmaceutical companies. Most of our healthcare exposure is geared towards domestic branded pharmaceutical companies that sell to Indian consumers, plus contract manufacturing companies, hospital chains, diagnostic companies. That's the texture of healthcare portfolio, and therefore our portfolio companies are not really impacted by pharmaceuticals. And on the manufacturing front, we are getting news by the day. So remains to be seen. It's a wild card. Let's see how manufacturing segment in India is impacted. At the margin, I would think that Indian manufacturing businesses might be a beneficiary as corporates realign their supply chain at a faster rate out of China into India and other markets. Just a couple of days back, India announced its annual budget. So it is one of the most keenly watched events every year, and a lot of announcements. I'll just summarize the four important takeaways of this particular budget. Number one, we saw a very clear focus from the government on improving the ease of doing business in India. And this has been a long-standing ask from corporate India, from businesses. And the government has done a lot over the years to simplify, to reduce the burden of compliance, And we have seen a very clear intent and focus towards further improving this ease of doing business, which to my mind is a very big positive. Number two, fiscal discipline. The government has maintained its discipline on fiscal spending. Fiscal deficit is targeted to be down to 4.4%. On the subsidy side, you've seen subsidies being flat to declining. And number three, what we also saw in this budget was a consumption stimulus of sorts by tax cuts. So up until, in the Indian context, sort of 6 times of the annual per capita incomes, up until that income level, income taxes, personal income tax rates have been brought down to 0. And that kind of gives consumption stimulus of about $12 billion to sort of the middle income segment in the country. And this had been an ask from the industry. Consumption, like I touched upon earlier, has been weak for a variety of reasons. And this, in a way, is a shot in the arm for the consumption segment in the country. And very importantly, number 4 is that there were no negative surprises. Right? So the absence of any negative surprise in itself is a positive in case of the Indian budget. So that's how I would summarize the key takeaways from the budget that was just announced. Finally, I'm going to wrap with the valuations. Right? Where do we stand? We talked about earnings growth. We talked about the drawdown that we have seen in the markets. Today, this is the valuation history of India, the long-term valuations. Top left, you can see, starting 1993, the average multiple, forward multiple, has been about 17.7 times. Right? That's a 30-year average, very, very long-term average. And the average of the last 10 years, the last decade, has been about 20.7. So these are 2 important long-term multiples. So number 1, you will notice that India has never been cheap, really, right? In the context of just looking at absolutely low PE multiples and comparing with other countries, India has always traded at optically higher numbers in terms of forward multiples. As we speak today, the multiples have dipped to, this shows 20.2, but over the last sort of 4-5 days, we've seen some further correction. So we're now closer to 19 times, 19 times forward multiple, which is at a what 5 to 7% discount to the last 10 years. So compared to the last decade, just about at a modest discount of 5 to 7%. Compared to the last 30 years, probably a 10% premium to the last 30-year multiples. So that's a quick context on valuations. We are at the 40-minute mark. I will take a pause here and would love to open the floor for questions now.
Thank you, Ayush. That's been really interesting so far. As you can imagine, we've had quite a few questions come in. I've sort of compiled these a little bit, but lots of them focus on valuations, which I think we'll start on, and in particular small caps. So while the investment case for India is very strong, what are your views on valuations, especially in the small caps?
Yes, certainly, and a very good question. So this graph encapsulates what is the range of dispersion when it comes to small cap valuations versus large caps. Right? So the bottom graph captures the premium that small caps or mid caps trade at compared to large caps on a forward basis. And if you closely watch this graph, you would see that the range has been on the lower side. We have seen small caps trade at 20% discount to large caps. And on the higher end, we have seen the premium expand to as high as 36.8%. Right? So small caps tend to have, as a basket, tend to have very wide ranges in terms of relative valuations compared to large caps. Number 2, you would notice that these tend to be very long, elongated cycles. Multiple expansions can last multiple years. So if you see the first expansion here in this graph started in 2012, and lasted till 2014-15. Then again, started in 2016 till 2018. From 2018 till 2020, it crashed from plus 26 to minus 20. And then since December of 2020, we have seen a 4-year expansion in these multiples. It peaked at 36.8%, and now they're down to 25%. So that's the history of how multiples have moved. Right. So compared to the long-term averages, small caps are at a premium. But very important to note that we do not take portfolio allocation decisions based on these multiples. In the trust, we run a structural tilt towards small and mid caps for the simple reason that small and mid caps tend to be very inefficient segments of the market. So therefore, they're fertile grounds for alpha generation. So we don't know whether small caps or mid caps will do better than large caps or worse than large caps. Over a very long period of time, we think they will do almost in line, but we have a lot of confidence in generating alpha from this segment of the market. And that's why the structural tilt towards small and mid caps.
Thank you. We've had a couple of follow-up questions to that, which I might ask. What have been the factors that have been driving small cap valuations, and will the increase in retail investors be having an impact on this? And if so, sorry, I'm piling a few questions together. Are those retail investors geared, and could this have an impact on the downside should one come?
Yeah, great questions. So I'm trying to address these. One is, what is leading to these sort of valuation increases and decreases? Secondly, is there a contribution from retail investors? And should we be worried? Right? So first, let's dial back to the years where we saw a sharp correction in these multiples. Right. So if you see 2018 is when we saw the prior peak for mid cap valuation premium at 26%. And coincidentally, the trust was also launched in 2018. Right. So this is when we launched the trust in 2018 with an overweight towards small and mid caps. And in fact, 2018 and 2019, let me dial back to how the trust held up during those years when there was a sharp pullback in mid and small caps. Right. So if you see in 2018, the trust had an alpha of 250 basis points. And in 2019, while the benchmark was plus 1.3, the trust had an alpha of 744 basis points, 8.8% returns. Right. So this is despite running against a headwind of mid cap factor doing poorly. Right. So think of it this way: there are two countervailing forces. If mid caps were to see a sharp correction, there is going to be a factor headwind to the portfolio, but then there is a countervailing alpha tailwind. Right. And that's how the two, and in both 2018 and 2019, the alpha tailwind was strong, much stronger than the headwind of a mid cap factor correction. Right. So that's how I would put it, that it's the nature of markets. Small caps and mid caps can trade at big discounts or big premiums. That is the case everywhere in the world. Today, if you look at the US markets, small caps are trading at a big discount to large caps. Right? In India, they're trading at a big premium. That will reverse at some point in time. We cannot time these cycles. Right? A very important part of our approach is you can't time these things. We don't time these things. Now, what is driving these cycles? So it's very hard to pinpoint. Typically, what happens is that if we look at the prior kind of expansion of multiples, a lot of it is driven by sort of stronger earnings growth in pockets of small caps and mid caps. Goes unsaid that they tend to be less liquid and therefore do see their premiums expand or contract much sharper than large caps. And yes, there is a bit of contribution from retail investors as well. So the small and mid cap segments has seen higher flows over the last couple of years, which has also contributed. So it's a mix of all of these factors. That segment has done well, has seen faster earnings growth over the last few years, also attracted larger flows, is less liquid, therefore sees sort of multiple expansion.
And then sort of the other side of that, does that mean that there's potential for it to fall more if there's that high liquidity in there?
Of course, yes. So it can go down. Like I said, the long-term range has been minus 20% to plus 35%, right? So there's a 55% swing that can happen. So in terms of possibilities, yes. Is it going to happen this year, next year, the year after? Nobody knows. And therefore, from a stock selection perspective, it does not add too much value, focusing too much on the factor cycle. So we know that, in fact, let me show you, this is a very instructive slide, right? And what this does is over the years, it captures what I just described, right? What is the headwind, factor headwind? And the size headwind is here, the last column, small minus large caps, right?
Yeah.
So in fact, the second last row is the size headwind. So if you see in 2018, small caps underperformed by 28%. In 2019, small caps underperformed by minus 19%. In both of these years, it was a headwind to our style, but still we had positive alpha. Then size has been a tailwind in 2020 and 2021. We had much stronger alpha. In the year calendar year 2022, again, size was a headwind, minus 760. Right? And then last 2 years have been a tailwind. It may turn into a headwind this year. That's it's par for the course. And these are cycles that always play out. Our focus is on stock selection, right? Our goal is to extract stock selection alpha, and over a cross cycle, regardless of these headwinds or tailwinds, that's how the portfolio is held up in good stead.
Okay, that's very comprehensive. Thank you. I've got one more stock specific question, and then we've got some more sort of macro orientated ones. One of those was on your top performer, Zomato, which has done very well in India as a food delivery business. Whereas in sort of Western markets, companies like Deliveroo, Just Eat have been struggling to turn a profit. What is Zomato doing right that the others are sort of not quite achieving?
No, great question. And I just add to just preface the question a little bit. So Zomato has two businesses. The one is the food delivery business, and then they have another business, a newer business, which would soon be almost half of the value would come from that piece, which is something called quick commerce, which essentially means that, let's say my iPhone is dead, I want to buy a new iPhone, I'm in a rush, I need it in the next 10 minutes. I can go to Zomato. They have an app called Blinkit. I order an iPhone. 15 minutes later, 10 minutes later, there is a delivery guy standing in front of the door with a new iPhone, right? So very quick commerce, indistinguishable from magic. That's how they put it. And quick commerce, and the way they do it is by having dark stores. So they have built a large network of dark stores in very dense metro cities, right? So in every sort of neighborhood, in every micro market, they have these dark stores where they keep a very curated assortment of products depending on the demand velocity, and then deliver these products. And it's not just food; it's essentially it's grocery, it's personal merchandise, it's beauty, whole host of products. So, and Zomato has really pioneered that business model, the quick commerce business model. It is gaining market share from traditional commerce, from traditional modern retail, from traditional retail, the Kirana shops. So, and of course, the food delivery business is chugging along well. And not to forget the food delivery business, that has been growing at about 18, 20%. It has matured to a great degree, but the quick commerce business is growing at 100%, 150% year on year. Right? That is the new growth driver for the company. And what Zomato has done is exceptional execution in both of these businesses. On the food delivery side, food delivery in India has devolved into a duopoly. There are only two companies with pretty much 60-40% market share. All right, about Zomato has about 60% market share. Swiggy number 2 has 40% market share, and they have just out-executed competition to gain that competitive edge. Right, and then on the quick commerce side, it's a 3-player market today. with some new competition. So Amazon is trying to enter the space. Flipkart is trying to enter the space. We'll see how this place evolves. Very early days. Quick commerce, it's a three-year-old phenomenon in India. There was no quick commerce industry that existed 3 years ago, and now we have seen sort of a multi-billion-dollar industry emerge with Zomato at the forefront. So it is exceptional execution, innovation, and being at the cutting edge of innovation in the consumer internet landscape in India that has allowed Zomato to really excel. I'm very happy to own this investment position. We continue to own it as we speak.
Very thorough. Thank you very much. So as promised, moving on to some of the more sort of macro questions. The one that came in quite early was that Indian markets have been historically quite correlated with the US. Do you see this changing going forward?
Okay, that's an interesting assumption. So not just Indian markets. In the short term, every market in the world is correlated with US markets, right? Now, if you look at Indian markets, and the perspective that you can take is that of valuations, right? How are India's valuations versus US valuations, right? So this is an interesting graph, bottom right. This captures S&P 500, which is the US index, versus the India index, right? And how have the relative sort of premiums moved? And the fascinating thing is that over the last 20 plus years, the valuation of India is identical to valuation of the US. So for most parts, India and US valuations have actually been identical. I'm not too sure about the correlation. In the short term, 1 day, 2 day, a week, a month, all equity markets tend to be correlated. But we have seen two distinct decades, if I may. So if you look at the first decade of this century, which is 2000 to 2010, India outperformed the US. And then the second decade, which is 2010 to 2020, US outperformed India. Over the last 20 years, both the markets have done pretty much the same, right? About, I think, maybe 7-8% in dollar terms. But the important difference, and this is something that, if there's one message that I would want to leave you with today, is that while the index returns have been identical over the last 20 years in India and US, the investor returns have been very different, because in the US markets, the average fund manager has negative alpha, negative 2%, 3%. In India, the average fund manager has a positive alpha of 2 to 3%, right? So even though index returns may be same, and investor returns are very different, right? And so this is a very important graph. This was compiled by the Wall Street Journal, this graph, and they looked at all of the large markets globally to see where it makes sense to go with an active manager and where it makes sense to just do index investing. And you would notice here that India is the most attractive market for active management today. It's a large enough market, it is deep enough, it is $4 trillion plus. That's the size of the market. And just for context, of course, US is the biggest market, about $50-60 trillion. Number 2 is China, 15 trillion. Number 3 is Japan, 6.5 trillion. And number 4 is India, 4 to 5 trillion, right? So it is a deep enough market, but still very inefficient. And to our minds, the single most attractive reason to invest in India is that we can generate outsized alpha on top of the index returns. And that's what the trust strives to do and has done over the last, since inception.
Very good, thank you. Just 2 more questions that I think we'll do to squeeze them in before 11 o'clock, if that's possible. I won't do them in those logical order, but I think there's a good question to finish off on. But just for now, I'll ask about the India's energy situation. It's benefited from quite low energy prices over the last sort of couple of years. Can this continue? And if they can't, with sort of the factors that have caused that to change, what are the consequences for the Indian economy?
Sure. So I'll share some rough math. It makes very good headlines that India's benefited a lot from low energy prices, buying cheap Russian oil, so on and so forth, right? That makes for good headlines. But if you run the numbers, and let's talk numbers, the annual oil import bill is about $180 billion, of which that's the gross bill. And then we also export oil after refining. So the net oil bill is about $120 billion, right? And this is pre-Russia Ukraine. At the peak, India bought 25% of its oil from Russia. At the peak, it's down now. And that 25% of the oil was 20% cheaper, right? You do the math, 25% of the oil is 20% cheaper, which means effectively a 5% benefit on an import bill of $120 billion. So $120 billion multiplied by 5% is $6 billion, right? Let's take it to 10 billion. So $10 billion has been the net benefit at the maximum by buying cheaper oil. $10 billion is not even a drop when it comes to the size of the economy and the finances, so on and so forth, right? So, like I said, it makes for good headlines, but when it comes to the country's finances, it is a rounding error. It is insignificant, immaterial. Like I said, the entire benefit would have been just about 10 billion, which is nothing in an economy that is $4 trillion in size.
Okay, thank you very much. And then the final question we'll go on to is just one on sort of India's outlook, in particular geopolitics. How do you see India positioning itself going forward, particularly given sort of the prospect of Trump over the next 4 years, India becoming quite a dominant world economy? We've previously seen China be very close to the US but then fall back. How is India sort of going to balance that going forward?
Very good question, Ryan. Thank you for that. And I think to its credit, I think India has done a fairly good job at managing international relations, geopolitics. Like you said, has been able to maintain very strong relations with the US, with Europe, even with Russia, with Israel, with Middle East, right? So they've been able to maintain very strong relations with very different, diverse set of countries. And that kind of positions India really well in the current geopolitical context. What I would say that a Trump presidency at a certain level is a wild card for everyone, right? And Canada and Mexico is realizing that. China always knew it. And many other economies all over the world would realize what kind of a wild card Trump's presidency is going to be. From an India perspective, right, we discussed two important vectors around technology and pharmaceuticals, right? Just going back here. So technology, we think it's a net positive for India. Pharmaceuticals, modest negative. Manufacturing remains to be seen. My hunch would be that it is going to be a net positive because the China plus one strategy that most corporates have been following will only gain more impetus over the 4-year tenure that Trump will have. And India has become the most credible alternative when it comes to boardrooms looking to build alternative supply chains, right? And Apple, as many of you know, Apple moved its manufacturing from China to India. Now, sort of iPhone 16, 17, whatever it is being made in India, and slowly you see the backend ecosystem also moving to India, and that has opened the floodgates, right? When corporates think that when the most innovative technology company in the world, Apple, finds it good enough to set up its manufacturing base, what is stopping many of the corporates, right, who are waiting on the sidelines? So I think given the kind of stance that India has taken from a geopolitical lens, we think that India emerges as a net beneficiary of the current sort of political construct of trade wars. And we're already seeing early signs, right? If you look at, maybe I'll show you electronic imports, right? This is a very good case study. Prior to 2018-19, right? I mean, they were languishing, and then they've grown 5 times over the last 5 years. And this is just the tip of the iceberg. This is how many other industries in manufacturing are growing. And that is the single most sort of implication of geopolitics in Trump presidency, which is realignment of supply chains, realignment of manufacturing.
Well, that's been very informative and very thorough. I should thank you very much for your time and for sort of the extra time we got given at the end for the questions that we always get when you're presenting. So it just leaves me to say thank you very much, everybody, for listening. Thank you, Ayesh, again for presenting. If you'd like more information, obviously, please visit the Kepler Trust Intelligence website where you can review the full notes. And also, if you want to watch back on the presentation, this will be available in due course. Just leaves me to say thank you very much and have a good rest of your day.
Thank you, everyone. Have a good day. Bye-bye.